Hi, everyone, and welcome back to another edition of Making Sense. And I've got Alex Letke and Justin Wolf from, I screwed up again, didn't I? Forest Area Credit Union. So, hey, guys, welcome.
Thanks for having
Pat.
us.
So we have, it's National Credit Union Youth Month and Financial Literacy Month. So we're talking about youth. And let's start first. How do you get a message to younger people? And what age should people start thinking about saving money, investing, building up credit?
Yeah, so I think that it really starts from the beginning when the parents at a young age can begin to teach kids about money and about budgeting. And there's a lot of resources, a lot of tools available to parents to be able to begin teaching that. But for a young adult or a teenager, really 18 is when you can really start doing some investing and that type of stuff. But it's a really throughout the whole childhood is when they can really begin to become financially literate in regards to money and stuff.
So talk a little bit about building credit. How do you establish credit?
Well, there's a lot of things you can do and some things you shouldn't do, Pat. Young people, again, if it starts at a conversation at home around the dinner table, talking about the responsibility of handling money, that's where it really all roots from. And of course, your financial institution, your bank or your credit union can help you with resources to help direct those conversations with your young people. But when we get into the teenage years and young adulthood, there are definitely some do's and don'ts. Building credit can start when you turn 18. Parents can often, guardians, family members, trusted people around them can help if cosigner status is needed, something like that. But oftentimes, we're working really hard to make sure we can help young people get started in building credit. And some of the keys are start small. You can get involved with a deposit secured loan to start building that credit, a small balance credit limit credit card, or a lower dollar value car loan. And doing really well at making those on-time payments is critical on those first credit trade lines so that you can build up as life progresses and as your earning increases and your needs increase for higher levels of borrowing. That's you're going to position yourself very well for it. As far as the don'ts, hey guys, don't forget that while repayment of things like electric bills, cell phone bills, and so on don't appear on your credit report, if you have a problem with one of those companies and they file a collection on you, it's going to hit your credit report. So you really need to think about your plan for spending, budgeting, and for borrowing and how you're going to meet those obligations so that it doesn't come back to hurt you when you really maybe need credit the most.
What are the different kinds of accounts that banks and credit unions can help you establish?
Yeah, there's a number of different accounts that we offer, starting with the basics of a checking and a savings account. And the difference between those two is a savings account is what it says. It's for individuals to be able to put money into, to be able to save for a rainy day or begin to find ways to invest those funds. Checking account is what you typically use for funds that you are using on a daily basis for transactions and things, money that's going out, funds that you want to use after you've put together a budget. The funds would go in there to be able to accomplish that. There's typically with youth accounts, we don't see this as much, but there are things like the money market accounts where it's more of a higher interest savings account. There are some limitations in that account, such as you're only allowed to do 6 withdrawals or transfers out of that account in a particular month. So there are limitations to that, but there is more interest that you will earn in that particular type of account. There are also certificates of deposit or CDs. That's where you put money into an account for a fixed period of time. So like right now, we have a 7-month promotional CD, but it's locked for that a period of time. And so you get a higher interest rate because that money is locked for that amount of time. But you have the ability to put that money in there and have a rate that you're going to be able to earn on it. If you do need that money, the money is available, but they're typically on a CD in any institution. There's going to be some type of fee if you wanted to break that. So if you needed those funds available, you typically want to have that in a money market versus a CD. But if you have money that you just want to put away for fixed period of time and you want it with the financial institution, a CD would be the way to go in something like that.
So we hear a lot about student loans. So what ways can you effectively manage those student loans?
Well, I'll start out by saying if a young person or at any stage in life, if you're considering utilizing student loans to finance further education, really think about it and approach it intentionally. Think about what you're trying to accomplish and what you hope to accomplish once you're done with the education. Student loans can be a great tool. They can also be a dark cloud. There's lots of options. Understanding what repayment terms are available in your particular student loan program is very important. Unfortunately, some people have found themselves many, many, many years after finishing their further education, still with student loan debt lingering over them. So, it can be really attractive to say, oh, I want to go do this and I'm going to borrow the money to do it. But think about the other half of that equation. How am I going to start paying that down? Much like a household budget or your personal budget. It can start with a piece of paper and a pencil, just writing down what's coming in and what's going out and making a plan for that period of time you're borrowing plus your repayment period. And of course, now there's a number of wonderful tools that we can access right on our smartphones or from our computers to help us with that planning. But Alex, do you have any other thoughts on how to actually, once that student loan debt is accumulated or in place, what's a good way to manage it?
Yeah, there's a technique called the snowball effect. And what you do with the student loans that you have is you line them up from the smallest to the largest, and you just start working on putting as much as you can on that smallest debt until that one's completely paid off. And then you take that payment that you were making on that smallest loan and just roll it into that next smallest loan until you get to that last one, and you get that completely paid off. It's called the snowball effect when you are paying off loans. And it works with any debt. I mean, it's not just for student loans, but when you're paying off your student loans, it's a great way to try and build some momentum, because when it comes to paying off debt, the majority of it's up here. It's a mental game of being able to pay it and be consistent in making those payments and making it happen. So
what are some of the options or the risks, I should say, and benefits of investments?
There are a lot of risks when it comes to investments. I mean, if you wanted to go Google FTX, I think there's some lessons to be learned right there. It's a company that went under because of some of the things that they were doing, and the guy's now in prison. So there's a lot of risks that are involved, especially with what things are happening today when it comes for investments. The most important thing to do when it comes to investments is find a number of different resources to get your information from. So you can go to YouTube. There's a lot of information out there. Go to all the different places that young people get their information from, but be sure to talk with a trusted advisor before making any type of investment decision, whether that's a financial advisor or that's your financial institution. Make sure to have those conversations of what are the risks involved in these different types of investments, because each one carries its own risk, right? That's why you earn interest, is because the funds are going to something that there's a risk involved in it. Some are going to be significantly less risky than others. And that, like a CD, is a very risk adverse instrument to be able to invest into, but you also don't get nearly as much of a return than you would if you were to go to like the market or something. So ask an advisor, make sure that you verify the information that you hear and the places that you go to for your information.
So as you grow older, so, when you're 18 or 20 or 22 and you're single, there's probably, here's some of the investments you can make now, but you may not make those same investments when you're 35 and starting a family, or when you're 60 and looking to retire.
Yeah. So when it comes to investments, I think some of the things when you turn 18, that's typically when you have to be able to make some of these investments. But working on your 401k through your employer, that's the most obvious one to be able to start investing into. Roth IRAs are another great instrument to be able to use, especially when you're younger, putting funds into that, because that grows tax-free. So that's a great instrument to be able to use. And you typically are able to have riskier investments when you're younger, when it comes to stocks and things like that. When you get to 60 and 65, you obviously want to have those in more of a bond or more of a money market, because you want to be in a risk adverse because you're getting close to retirement age. So you want to be able to manage that. Just to your point, as you get older, you want to have less risk involved in your portfolio. And there's other avenues as well, whether it's real estate or different things that you can be looking at from an investment perspective. But for the young individuals, working with your 401k through your employer, Roth IRAs, and finding a way to get with a financial advisor that's able to help you navigate what's the best for you in your situation. Because every situation is different, right? My situation is different than Justin, which is different than yours, Pat. We all have our own things, and our financial advisors are really able to help navigate what makes the most sense for you.
Well, and let's talk a little bit, speaking of risk, let's talk about credit cards and how important it is to manage that and the interest on credit cards and understanding that, because that can get away from you.
It sure can. And, credit cards can be really great tools. They can also lead us down dark paths if not used properly and if not used intentionally with a plan. Credit cards are a great purchasing power tool. They're very easy. They're very convenient. We can load the data into a digital wallet on our phones, and it just makes transacting business of our daily lives so easy. The cost is that's a method of borrowing money. And on the good side, oftentimes, if you borrow against your credit card today, as long as you pay that dollar amount back within that first billing cycle, you're not going to pay a finance charge. So that's great. You're using somebody else's money effectively for free. The finance charge comes into if you carry a balance past the billing statement, past the billing period. And what we find is often on credit cards, those interest rates are very high. There's a lot of things involved in the interest rate determination on credit cards. And of course, you can go out to the internet and see the long list of credit cards that are available at the varying interest rates. Some will have high rewards, and they usually come with really high interest rates. Others might have low rewards and lower interest rates, but this is unsecured debt most often for the creditors that are issuing these cards. So by nature, they're going to charge higher interest rates than you would on a car loan or a mortgage loan, just because there is more risk for that creditor being unsecured debt. And then some of the real danger with it is if we don't have a plan on how we control our spending, if we're spending based on emotion rather than plans, and sooner or later, maybe we find ourselves overextended on these credit cards. The way credit cards bill, they charge an interest rate towards the finance charge. But, the minimum payments, I'm sure, as most everybody watching tonight knows, is not going to get you very far in repaying the balance that you borrowed. It's a very long repayment period if you go with those minimum payments. So it takes a lot of discipline to make sure you have a plan and get that repaid in a way that is going to minimize the overall finance charges that you make. I'm not here to say don't use them, but use them wisely.
So we talked a lot about, I just kind of want to recap, and I think the message here, and you encourage, once you turn 18 or you're young, start investing or start planning a little bit. Is that the overall message? It's not, it's not too early to start. You think, boy, I got my whole life when I'm 18, and you blink your eyes and you're 65 and ready to retire, but get in the game early.
Yeah, compound interest is a magical thing, right? Even if you can put away $50 a month when you're 18, I mean, it doesn't feel like a lot, and you feel like, well, it's not going to do me any good. But at the end of the day, if you're putting that away every month, over time, that compound interest is really going to grow. And as you get older and have more money to be able to put into it, it's just going to add to it. I mean, there's the old adage of the first $100,000 to save is the hardest to save. And then once you get that tucked away, it just starts to grow and grow and grow. But it's a grind to get to that first 100,000 to be able to get that put away. But if you start when you're 18, it's going to grow a lot faster for you.
And also utilize those resources around you. We talk about trusted advisors. Sometimes we hear the word financial advisor and we think automatically, there's probably a cost associated with that. Young people, even before you're 18, reach out to your bank or credit union. Believe it or not, that we have resources. Most every bank and credit union does. We can help point you in the right direction. We can direct you to tools and resources that have been reviewed and we deem to be safe and truthful. So again, lots of information out there on the internet, and that's a great way to get it. But circle back to your local bank or credit union because we're all glad to help.
All right. Justin, Alex, thanks so much. Great information for everyone. Appreciate your time tonight, and we'll see you next time on Making Sense.
Sounds good. Thanks, Pat.
See you guys.